someone that needs no introduction, the chairman of New York Investment Sales, Bob Knakal.
But things aren't working the way they are supposed to work. U.S. debt gets downgraded in April of 2011. Interest rates are supposed to rise, right? They drop like a stone. The government has quadrupled the money supply in the country. Inflation's supposed to be rampant. There's no inflation. So where's the market going? I have no idea. I'll give you some statistics and we can talk about that. Okay, in the multifamily market, we're going to look at three sectors. We're going to look at the overall market, and then we're going to disaggregate multifamily into two categories, because in New York City, we view elevated properties as a separate asset class from walk-up properties. So if we look at the broader market in terms of volume, we're going to look at volume metrics and value metrics. In volume, so far this year, we're taking year-to-date numbers, annualizing them so we can compare apples to apples. Number of multifamily buildings sold citywide down 28% from last year. Dollar volume down 24%. Total number of units sold down 48%. Gross square footage sold down 49%. And what you're going to see throughout these statistics, you're going to see that the volume of sales is way down, values are up a little bit, and it's going to be a fairly consistent picture. Okay, so if we look at value metrics, we see that the average price per unit in the city up 11%, average price per foot up 13%, average cap rates down about 20 basis points, and average gross rent multiples are up a little less than a full multiple. So these are very positive signs, but this is also indicative of a market that is in transition mode, where volume stops, value stays high. That's a function of sellers who are actually selling capitulating, and sellers who are not getting bids they're happy with don't sell, so you get less transactions happening, but those that are occurring at better price points. So let's look at elevator properties now. In elevator, we see that elevator properties are selling less frequently than walk-ups are. Number of buildings sold down 49%, dollar volume 40%. Number of units sold, 45. Gross square footage, 48. On the value side, average prices are up 3% on a price per unit. Price per square foot is up 3% to over $500 a foot. That's the first time we've eclipsed that number. Average cap rates down, pretty much flat. 7 basis points effectively is a flat cap rate, and also effectively a flat gross rent multiple at being up just slightly. If we look at walk-up properties in the same way, we see they're performing a little better. They're only down 21% in terms of number of buildings sold. Dollar volume down 22, number of units down 53, gross square footage sold down 52. These numbers are massive. You know, when you look at a market and you see a 5% difference, an 8% difference, those numbers usually are meaningful. Usually don't get up to numbers that are this large. So these are very, very significant. We look at value in the walk-up sector. Average price per unit is up 14%. Price per square foot up 15. Average cap rates are down about 1/4 point. And average GRMs are up almost a full multiple. So these are very positive indicators on the value front, but the volume just isn't there. And if we look at all of those numbers together, you can see there's a lot of red across the board. The elevator sector is hurting. Sellers just are not selling elevator buildings today. They're holding on to them. And walk-up buildings also are not selling so well. But on the value front, you see that with the exception of elevator buildings where the average price per unit is down just slightly, effectively flat, you see that there are positive metrics on the value side. So if we look at Manhattan only, the Manhattan market is usually a bellwether for the market. It usually leads markets when they shift or when they change. They're usually very indicative of where the market is headed. We look at these same statistics, and in Manhattan, number of buildings sold down 44%, volume of sales down 47%, total units down 68%, gross square footage down 70%. On values, for the combined market, values are up 7% a unit, price per square foot up 10%, average cap rates effectively flat, they're down slightly, and average GRMs also effectively flat. But at the levels of these numbers, the $844,000 per unit, that's an all-time record. $1,067 per square foot is an all-time record. The average cap rate on a combined basis at 355 is an all-time record, as is the 19.44 gross rent multiple. If we look at elevator properties now, again, number of buildings sold, is that we're on pace for only 51 elevator properties to sell in Manhattan this year. That's an incredibly low number. Dollar volume down 59%, number of units down effectively 70%, gross square footage 72%, and on the value side, values per unit down very slightly, effectively flat. Price per square foot is up 4%. The cap rate at 3.18 for elevated properties in Manhattan is not an all-time record. In 2006 or 2007, I believe, we'll get there, the average cap rate was 3.05, which was the lowest, so we're not quite there. Average GRM, just under 20 times the rent. If we look at walk-up properties, they're down, number of properties sold, 27%. Dollar volume of sales, it says plus 39. It actually is plus 21. There was a sale in there that I just caught a couple of hours ago that was a portfolio that had an elevated building in with a bunch of walk-ups that was counted in the walk-up data. We need to count that in the elevated data, but the dollar volume of sales in walk-ups is actually up 21%, not 39. Total number of units sold is down 56, and again, gross square footage 52. So notwithstanding Stuyvesant Town, these volume metrics would hold in the walk-up space, and these numbers are still very significant. So I'm not aware of any outlier transaction in the walk-up sector that would have affected these. Average price per unit, walk-ups up 13%, price per square foot up 12, average cap rate up just 9 basis points, effectively flat, and average GRMs are also effectively flat. But these metrics, if you look at them all, you see a lot of red on the board, and I'll put an asterisk next time and mention the Stuytown and do 2 sets of numbers, but I think that, we're feeling a lack of supply on the market, and that should translate into fewer transactions, and that's what's happening market-wide anyway, in all product types, not just in multifamily. So again, the value metrics, a lot of green on the board. There's still upward pressure on pricing, but again, that's because only the sellers that are getting their prices are actually transacting. Those that are not transacting. If we look at a 32-year historical perspective, you see these are cap rates. In blue, you have elevator buildings, in green, walk-ups. You see that 2006 record of 3.05% as the cap rate. But one of the interesting perspectives that we take on this is that we'll compare these, well, let's look at gross rent multiples also. And the interesting thing, if you go back to the cap rates, you'll see there have been times when average cap rates for walk-up buildings have been lower than cap rates on elevator buildings, which is interesting. Normally that's not the case, but if we look at gross rent multiples, you see they're highly correlated, very highly correlated. And it looks as if it's kind of the same deviation, but market conditions are very different. If you look at 2016, currently there's about a half a multiple difference between walk-ups and elevators. That same half multiple difference occurred in 1992, but in 1992, that half multiple difference amounted to about 13% of a multiple, where today it's nearly 31%. So the correlation, we should do it on a percentage change, not the absolute change, but clearly they're highly correlated. Here we're layering in Manhattan elevated cap rates to gross rent multiples. You see the relative inverse relationship that they have, and the same thing for walk-ups compared to gross rent multiples. If we look at cap rates compared to mortgage rates, this gives you an idea of whether there's positive or negative leverage in the marketplace. And with the next slide, we're going to compare those two. You see that there have been significant times, the red means that there's negative leverage in the market where cap rates are below lending rates. This is incredible. This has to be probably the only market in the United States where this exists, but it exists, and it exists very significantly. If we look at comparing those cap rates over time to the 10-year T-bill rate, which is the risk-free rate, and look again at the difference, we see there have been periods where yields on risky real estate, although it's not that risky compared to all real estate types, but yields on real estate have been less risky than a risk-free investment in the 10-year Treasury, which is really remarkable. But if you look at where we are today, even with these low cap rates, you see that investors are still getting a much better bargain for their investment than they were getting in 2005, 2006, or 2007, because the spread between cap rates and the 10-year Treasury is much more significant than it was in the past. If you look at the early 90s and see what cap rates were trading for then as a spread over Treasuries, it would be the equivalent of getting an 8 or 9% cap rate on an apartment building today, which would be absolutely unheard of.